Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. And we're talking Fed Watch, where risk management continues. Widely expected, right? Federal Open Market Committee implemented another 25 basis point rate cut at the October FOMC meeting, and that brings the new Fed funds trading range down to 3.75 to 4%. And with the resumption of rate cuts now at round 2, and Chairman Powell referencing the resumption of rate cuts as a risk management approach, I think the more pertinent question is, what would the Fed have in store for the markets for the December FOMC meeting and, of course, 2026? First up, let's look at the key factor in the Fed's current decision-making process, namely the labor market backdrop, right? The Fed does focus on their dual mandate of employment and inflation, but there's no question the primary focus right now is on the employment side of the equation, especially given the recent stalling out in new job creation. But at some point, if the upcoming jobs data don't deteriorate any further, maybe the policymakers shift their attention back to an equal weighting for inflation. And it's interesting that recent reports on inflation, such as CPI, they haven't revealed any meaningful tariff-induced impact yet. But underlying data have shown that the spring bout of disinflation is now over and that price pressures are now grinding higher. In fact, core CPI is running at an annual rate of 3%, and that's moving further away from the Fed's target of 2%. For the record, their own preferred inflation measure, core PCE, is also moving further away from that target, and that, at latest read, was 2.9%. So looking ahead, monetary policy does still seem skewed towards a further rate cuts. How many forthcoming? That's the great unknown at this point. The voting members seem to be tilted towards another rate cut at the December Fed meeting, even though Powell at the October presser said it's far from a foregone conclusion. It's the outlook for next year, though, that I think is more cloudy. And once again, there's a disconnect between the Fed's own projections and what the money and bond markets are expecting. The most recent dot plot from the policymakers looked for only one rate cut in 2026, but the implied probability for Fed funds futures, that stood at 3 easing moves prior to the just completed Fed gathering. Don't forget the balance sheet. The Fed announced today that QT, quantitative tightening, is coming to an end on December 1st. So the bottom line here is, based upon the broader economy during the pre-government shutdown, there doesn't seem to be a need to go into an accommodative phase for policy just yet, but perhaps just getting back to neutral. And this is a point Powell and company have been making as well. So what is now a neutral Fed funds rate? That's the key question. If you believe it begins at perhaps 3.5%, then investors could expect to see one more quarter-point rate cut before a potential pause. And besides the most recent CPI report, both the Fed and the bond markets continue to await fresh official economic and inflation data. And once the shutdown does end, it could very well be a deluge of information that gets released. And it's against this backdrop, any moves beyond a risk management one will certainly be data dependent, especially on the employment front. I'm going to end it there. Have a great rest of the week, everybody, and be well.